It's my pleasure to be here. My background is with the Software Development Forum, which put on a lot of programs like this, so I've had the pleasure of being part of programs like this quite a bit. And even so, I'm still in awe of the speakers that are here today, and in particular as part of our panel. Rather than trying to do each of them justice, what I would like to do is give each of them a chance to introduce themselves, and then we'll go through some questions that we have, and then open it up to your questions as well. So I'll start with Jeff Chambers.
Okay, thank you. My name again is Jeff Chambers, and I am a managing director of TA Associates, which is a private equity firm. I actually graduated from Stanford Business School in 1980 and joined TA right out of school, so I've been there ever since. What we do at TA is we invest in privately held companies that are growing and profitable at the time of our first investment. So we're not in the startup business like Ron, but we're also usually, almost always actually, the first institutional investor in those companies. So they are profitable, but they've achieved profitability without having raised institutional capital. And that'll be kind of a theme in some of the comments that I'll make as we go forward today. Ron?
Ron Conway. I'm the founder of Angel Investors LP, which is a fund, two funds, a $25 million fund that was started in '98 and a $150 million fund started in '99. And our focus, like the name Angel Investors, was to invest $500,000 to $1 million in early stage internet startups. So we're very focused on the internet, for better or for worse. And we basically put together a group of angels who are the investor base who invested the $175 million in the fund. People like Bill Joy, one of the founders of Sun Micro, Mark Andreessen from Netscape, Pierre Omidyar and Jeff Skull from eBay, and then many of the founders of Yahoo, Amazon, other internet companies. So basically, we had internet entrepreneurs investing in internet startups. And 80% of our deal flow actually came from the internet entrepreneurs who were the investors in the fund. So it was very, very synergistic and very angel-oriented. We made over 200 investments, and our claim to fame is we were early investors in Google, and so we're hoping that makes our investors happy. But the search market, we were also early investors in Ask Jeeves. So we think there'll be many iterations of search in time.
Okay. My name is Ken Burkhardt. I'm the chairman and CEO of Aloha Networks, an early revenue stage company in San Francisco. I've sort of been involved in the high-tech and the financing area since the late 60s. Interestingly enough, I have no degrees whatsoever in either business or finance. I have an undergraduate degree from Cornell in physics and a master's in computer science from Rutgers and a PhD in computer science from the University of Washington. And I think having had no formal financial training has probably been a big help in terms of realizing money is a very important way to grow a company. My previous company was a company by the name of Dialogic, which together with two friends we built from nothing to about a 1,500-person company that Intel acquired in 1999. So I have some interesting stories about some creative ways to grow things in ways other than just getting VC money.
I'm Kim Fisher. I'm the executive director of the Women's Technology Cluster, which is a incubator for early stage businesses run by women where we help them raise capital, close deals, build their businesses. I was thinking about this panel and my relation to it, and I think somehow, even though I don't enjoy raising money, I've made a career out of raising money in a lot of different circumstances. So for the nonprofit I run now, we raise about $1 million a year. It's also a startup. I started my career starting a fitness center, relevant to any of you who were at the last panel, and raised $1 million for that from bond traders that I was personally training at the time. Moved on to have an experience raising $26 million in traditional venture capital and also from strategic partners for a high-tech company I founded. And I have a lot of stories about the companies that I currently help, working with 25 really talented women-led businesses who are all raising financing in a lot of different ways in today's market. So I'm looking forward to sharing some of those stories.
Thank you all very much. And I suspect you all are already starting to think of the questions that you want for this particular group, because there's a pretty diverse set of experience here. I'm going to start with a question for Jeff, but all our panelists will have a chance to jump in on these questions once the prime person has had a chance to answer it. Jeff, your experience has been really extensive, finding companies that have reached the point of profitability without getting venture capital, or at least not getting it from you. Can you give us some examples of an example of an entrepreneur who was very creative in how they raised capital, and also talk a little bit about the pros and cons of the various types of creative financing strategies?
Sure. I think my view is that the answer to the question about creative financing in different structures really varies depending on whether you're talking about earlier stage companies or later stage. I think in companies that are profitable, there's lots of opportunities to be creative in financial structuring, that sort of thing. But to me, in an early stage company, the creativity comes in not doing a financing. The creativity is in building a business without having to go out to investors. These are the kinds of companies that we've backed for many years at TA, and have grown to love the entrepreneurs who run them, because they develop incredible disciplines over the years. And Ken can talk about this a lot better than I can, when they don't have a lot of money to start their businesses. So to me, creativity is not having to give up equity to finance a business. Creativity is convincing business partners as opposed to investors to put up the money, whether it's suppliers or customers or other partners out there who might have some interest in your business. And really, creativity is coming up with a business model which enables you to get to profitability as quickly as possible. Find a customer who wants to buy a product at a profit from you as quickly as possible. I think that's infinitely more creative than coming up with a tricky preferred stock structure from a venture capitalist. Because in the end, no matter how creative you are in those structures, you're going to give up equity. And if you're talking about the professional venture capital community, you're going to give up a lot of equity. We were talking earlier about 700,000 companies formed in the U.S. every year. Only 7,000 of those start with venture capital, like the kind of venture capital that we all read about here on Sand Hill Road. So there's 693,000 people out there who did something different. And over the years, we've seen all kinds of interesting things. You asked about examples, and I was thinking about that. There was a guy back in the early 80s named Mike Stansberry down in San Diego. He used to fly to Las Vegas and play poker on Thursday night and come back Friday morning and meet payroll. That to me was creative. Maybe a little more traditionally, the founders of ECAD, which is a company that became Cadence, they saw a product inside of their company, Gould, which the parent company didn't want anymore, so they convinced Gould to give it to them in exchange for 25% of the first $1 million of revenues. And there was really no capital required to do that. Many of you here have heard the story of McAfee, John McAfee, who raised $2,000, had a software guy develop a product. He put it up on a BBS long before there was an internet, knowing that people would steal it off of the BBS and take it to work. If he put a legend on that product saying that companies could not use it, people would take it to work. It would proliferate inside companies. Eventually, companies would find out that they had it and volunteer to pay John and call him up. So he just put it on a BBS and waited for the phone to ring. And in his first full year, $5 million came in through the door without his ever making a sales call. So to me, that's creative. On a smaller scale, a couple guys that I used to know who had a really small business. They had a big order from Kmart coming to them if they could just prove to Kmart that they could deliver. And Kmart wanted them to show Kmart the trucks that they had to deliver all the product. So they went to a friend of theirs that ran a truck rental company, asked them to bring 10 trucks over to the parking lot. They went and made up some signs with their logo on the side, They stuck those signs up on the side of the rental trucks covering up whatever the name of the rental truck company was. Brought Kmart over. Kmart looked at the trucks, said, okay, you got the order. They took the order and went and borrowed the money to buy the trucks, and they were in business. So to me, those are the creative stories in financing out there. I think as you go into the later stages, there's all kinds of interesting creative things you can do with redeemable preferred structures and variable conversion rates depending on performance and that sort of thing. But those are discussions that you best have when you're profitable, not in the early stages of a company. I think if you do have to raise equity in the early stages of a company, and many businesses just require it, my advice there would be don't be creative. Try to keep it as simple as possible, because what you really want to do is get the interests as closely aligned among all of the investors as possible. As far as other kinds of financing, I mean, things like venture leasing and that sort of thing, and frankly, the kinds of companies that we deal with don't do a lot of that because they don't have a lot of assets, so they don't have to borrow money to buy assets. And again, it's better if you can use rented space as opposed to go buy a bunch of furniture or borrowed space rather, use a bunch of furniture buy a bunch of furniture and have to borrow the money to do it. So most of the companies we deal with don't have any debt. Ron, some of your companies I'm sure have used a lot of venture leasing kind of capital over the years because they're just more capital intensive businesses. So again, we've got the bootstrapping focus and be happy to answer questions on that as we go along.
You have a complicated round, and then you run out of that, and you have to raise more money. Having the complicated structure in place can make it more difficult to do that. Having said that, I just did a recap at Aloha, so I'm very familiar with that. I had 3 different types of preferred stock plus some secured notes, and was fortunate in convincing people to convert all the secured notes and the previous types of stock into regular equity, so that made life a lot easier. But simple is good. If you have to do it simple.
I just want to add that, while Jeff's company might have been unique 10 years ago in only investing in profitable companies, more and more firms, at least over the past 5 years or 3 years at least, are only investing in companies that have at least significant revenue, if are not profitable. And while those are creative financing strategies that used to be an option, right now a lot of the companies we work with, venture capital is something that they would take if they could get it, but not everybody can get it, and you can't get it at a certain stage. So there's a gap you have to get over, which is where those creative financing strategies are really useful, because if you don't have product and you don't have revenue, it's really hard in this market to raise venture capital, and so you have to look at those strategies. It's a necessity.
So on a related topic, question for Ron, what should entrepreneurs then be thinking about when they're considering pursuing different financing options? And what do you think the key challenges are that are facing entrepreneurs today?
I'm going to answer the second question first, which is, what are the challenges facing entrepreneurs today? And from the venture capital point of view, which is the point of view that I'm going to talk from, the biggest challenge that entrepreneurs have today is that venture capitalists are not venturing much. The overhang from the bubble bursting is still around, even though we're seeing a slow resurgence in the market. Lots of venture capitalists are still spending lots of time fixing the companies that got broke when the bubble burst, and that takes up a lot of their time. So they're looking at fewer deals. And what I've said to other venture capitalists who I'm trying to get to invest in new startups today is, you're venture capitalists, but nobody's venturing. The venture piece is left. As in, VCs today are not looking for high-risk deals. They're really looking for deals more like Jeff's, not companies that are profitable yet, but they are looking for companies that if you're selling a product or if you're designing a product, that you've actually sold some of that product. Whereas 4 years ago, at the height of the bubble, you could actually get venture funding not having any sales at all, and maybe not even having finished the product development. those days are in fact behind us. I'm not sure in our lifetime it'll ever happen again. But you need to keep in mind that you shouldn't even bother going to a VC until you have some amount of proven revenue. I really don't know any VCs today who are investing in companies that don't have some proven business model and or actual revenue to show for the market demand of their product. So before you go for venture capital, I would advise what Jeff said, which is try and bootstrap yourselves as long as you possibly can before taking any investment capital from anyone. Try and use your own resources, working for zero salary and getting other people to help you with the services that you need to prove out the idea. And once you at least prove out the idea, then go look for some angel investors to come in and bring in $500,000 to $1 million, which hopefully will get you to the point where you have sold some of the product or service that you're offering, so that you can go to a venture capitalist and say, I do have some sales. Because without that, I don't think you're going to get venture capital. Now, in looking for your angel investors, you should absolutely spend a lot of time researching who are other people in the market area that you're trying to service who have succeeded in that market. If you're designing a software product for customer service, try and go find a successful entrepreneur who was in the customer service business and get that person to be your angel investor. So all I'm really saying is find somebody with domain expertise in the market that you're pursuing. Don't just find an investor. I mean, if you have to, families and friends will do, but as you go on, every layer of investment that you bring in, that new layer of investment looks at the pedigree of the investors before you. So, Andy Bechtolsheim was the first investor in Google. Do you think that got John Doerr and Mike Moritz's attention, the fact that the founder of Sun Micro was the first investor in Google? That deal had high pedigree from day one, and I haven't talked to Larry and Sergey about it. I probably should. Did they target him strategically? I bet they did. He's a Stanford grad, et cetera, et cetera. But that's what you want to do. You want to really bring in angel investors that have strategic value to you and will impress the next round of investors that you go after. So you need to build momentum each round of financing and get people with even higher pedigree. When you go for the venture round, go to venture capitalists who have invested in your segment. Don't just go to any VC. And then, so find a VC firm that invests in your segment, and then find the partner in that firm that you think is the most relevant to you and will actually get what you're saying. You don't just send an email to XYZ VC. Go target the exact partner, and when you meet with that partner, tell them why you've targeted them. VC partners don't hear that very often. Hey, we targeted you because we think you will add value to our company. I rarely hear that. But that would be a relevant pitch, and you're patting the VC on the back at the same time. The other thing that I want to say, and then I'll wrap up, is these days you've got to do more for less. In other words, the less you spend, the less dilution you're going to suffer in your company. And I'm involved in a company right now that's about to get VC financing, and so they added money to the budget. And I was sitting in a meeting yesterday where they added $1 million, and after the meeting I said, why'd you add $1 million to the budget? Well, they're close to funding us, so we figure we'll get another $1 million. So one of the founders owns half the company, and I said, do you know what that extra $1 million is going to dilute your ownership in this company? And it's money that you don't need. I know you don't need it. And you should be reducing the amount of money you spend, not increase it. You should be buying your hardware from eBay. You should be, interviewing any vendor who will work for you, on a barter system, or give them a few shares of stock. you got to make the money last longer because there's less of it out there.
Ken, on our panel, is the one person who has actually started a company, built it up, sold it ultimately to Intel for $800 million, and never took any venture capital along the way. So the natural question for him is, how did you survive all those years? And if you could do it over again and had the option of taking VC money, would you? And then one final question, if you have time after addressing those. Now that you're at Aloha Networks, what strategies have you employed, and would you take venture capital again if you could?
Okay, let me try number 2 first. Would I take venture capital at Dialogic? The answer is absolutely not. I'm glad we did, and it was marvelous. When we were public for 5 years. When we went public, the founders of the company owned 90% of the company. The other 10% was stock options to employees. So if you can do it, that's great. You can't always do it. We were fortunate in that we could, and it's kind of interesting. I went to the sports and outdoor session this morning, and some of the things that were said there kind of applied to Dialogic, which is sort of in line with some of the conversation here, which is, if you can build something and sell it, even if it's small, just that you can prove that you can build it and sell it, well, that's great. You can't always do that. Aloha's an example of where you can. That really is rocket science, but hopefully I'll get to that. With Dialogic, we started out with a very, very simple product. If you don't know what Dialogic did, you may not have heard of the company. You've undoubtedly talked to it. 40% of the voicemail, automated response, unfortunately voice dialing systems as well, were built using Dialogic components. I want to say we were brilliant when we came up with this idea of selling to OEMs rather than to end users, but when you don't have any money, it's a lot easier to sell to OEMs than to end users. Basically, the way we started the company, the first year we were totally in hidden mode, totally financed by ourselves. We had the idea and built the first prototype of the product, and about a year later started to sell it. Sort of the joke then was everybody hated board meetings. We'd have them every 2 weeks, and the last question of the board meeting was, well, Ken, what does the check have to be for this week? Having said that, the checks were not that big. We really didn't put a lot of money into the company, but we did very early on start selling product. We had one employee in the office full time, and 3 of us were sort of working other jobs while we got the thing bootstrapped. When we started to see some volumes, we started to introduce some additional products. I was able to convince a company in China that wanted to move from the digital watch arena to the semiconductor and board manufacturing business, that we were a real company. I had to go over there and eat all kinds of things that normally I wouldn't even stand next to, but was able to negotiate. I had snake more ways than you can imagine. I was able to negotiate 120-day terms, and one of the nice things about the Dialogic customer base is we actually helped the whole market for voice processing grow. We had a lot of flaky customers, but we had a lot of them. And if you didn't pay us, you didn't get product. So we would start COD. From day one, we had a very, very rigid accounts receivable policy. So we had 120 days to pay our vendor, and we were paid always in less than 30 days. That allowed us to get to the point where we could pretty much survive on our own with normal terms and conditions. And part of that was because of the margins that we shared. Unlike the folks in the sporting goods industry where they talked about being limited to maybe 20% a year growth, we had gross margins on the order of 65%, so that after a couple of years of starting, we were profitable and were able to fund and pretty much grow on our own. And that was it. That was really it. We did have some conversations with later stage VCs. There were situations when we might have sold off a piece of the company, but we never could arrive at an understanding on price. So when we went public, we were quite happy having been that way. Now, to answer, I guess, the third question, what about Aloha Networks? I was actually brought into Aloha. It's a very different situation here. The company's technology supports high-speed communications, high-speed wireless communications. The first product is high-speed wireless communications via satellite. And our claim to fame is that we're faster and about twice as efficient from a cost standpoint than the technology that's used today. At a simplistic level, the stuff today in satellites is all circuit switched. It's basically TDM. Whereas our stuff is a combination of Aloha, which is the backbone of Ethernet, and spread spectrum. So we've got a whole bunch of neat advantages. The problem is there was real rocket science. We started out with some patents and some theory and had to build that into a product. So we didn't have the alternative of having a whole bunch of small customers. We have a small number of big customers, and we are starting to ship product now. But we did have to take venture capital, and if someone wanted to give us some more venture capital right now, I'd be quite happy to take it. Basically, what's kept us alive and where I've been able to get the most response in terms of raising money and keeping things going over the last 2 years is individuals. Wealthy individuals who understand the market and are willing to take a flyer.
So would that be traditional angels or?
Some of each. Actually, when I first joined the company in perfectly bad timing, January of 2000.
That's why they brought you in.
Yeah, perfectly bad timing. I did raise some money from an angel group out of Summit, New Jersey. But I would say over the last several years, they really haven't been traditional angels. There have been some people in San Francisco running a very successful gentleman in the wine business out of Australia, which, Australia, they kind of understand the problem of long-distance communications and high-speed internet access when there's no phone lines. One of the things I found in the U.S., if you talk to VCs, they don't think it's a particularly interesting market, that there are any areas in the world that don't have ADSL. Well, aside from my office and 2 houses in New Jersey that don't have it, in the third world, it's pretty straightforward that it's not there.
Yep.
But so it is more difficult if you can't introduce a product early and if there is a lot of real science to making it work. So I guess part of my suggestion to people that we're talking about or thinking about starting a company is that one of the things that makes it easy to get money is if you can think of a way to get something out there quickly to prove it. And it's a lot easier to get funding if you've done that.
Yeah. Which I think is a recurring theme that we're hearing in this session, and I suspect has come up over the course of the day as well. Kim, having been both an entrepreneur and an investor, and I don't remember if you touched on it in the introduction you gave, but I believe you were with Motorola Ventures as well, so you have venture capital background. Can you give us some insight on the criteria you use when you're screening potential WTC companies or evaluating their possibility for venture funding down the line? And what are some of the do's and don'ts that entrepreneurs should be thinking about when they are approaching investors?
Sure. I actually want to lead off of something Ken just said, which is this experience in Australia where they understood the need. And while you'd like to think that all investors are, strategic and analytical, I've found personally as an entrepreneur, as well as being on the other side, that a lot of times if you can really personally understand the need, it helps a lot. So that's a good and bad thing to know. So I guess the no-brainer answer to your question, Sandy, about what do you look for in terms of looking at a deal, the answer that you all know, having been to or being in business school, is that we look at unique technologies with profitable markets led by stellar teams who can really bring the product to market, bring the company to profitability, and ultimately to a successful exit. Some of the more interesting things I want to share with you, and I tried to think of 3 or 4 things that weren't such no-brainers about what investors look for and how to go about approaching investment capital. The first is to start strategic, and I believe Ron made a comment about how you should look for the partners that you want to talk to and look strategically about who would be interested in investing in your company, and opportunistically. And the reality is, when I look at all of the companies I've started and the companies that I work with, a lot of the investment capital that comes to them is opportunistic. I started, I'm sorry, I'm going off my investor focus here, but I'm an entrepreneur at heart. I started my company Audio Basket, figuring out, okay, who are the investors who would be most interested in this? And then I ended up telling my uncle about it, who was playing golf with some venture capitalists in Florida, and they ended up being the lead in our A-round investment. one of the big investors in our B round of capital came from an investor conference that I presented in. Someone from Time Warner Investments, which is now part of AOL Investments, was there listening to me. And I didn't even think of them, but they ended up putting $4 million into a B round of capital. So, keep your mind open and keep getting the word out, but also be strategic, or at least have a strategic starting point. I have a great story from one of the entrepreneurs I work with today. It's a social venture that we work with, because we work with at the WTC with life science, IT, and social venture companies. They were in a cab in New York. They ended up approaching a cab at the same time as this other gentleman and decided to share the cab. And as they were in the cab heading from downtown to uptown, this gentleman asked her what her business was, and she started describing the business and told him what she did. And he handed her a piece of paper when he got out of the cab, and it turned out to be a $10,000 grant, basically. He handed her a check and said, "Good luck." And she didn't even know until she opened it. So, it was a brilliant story, and it's, rare, but get the word out. The other thing is to really go after the right funding targets at the right time. So while I'm saying be opportunistic, be aware, everybody has said here that, you can't get venture capital without revenue. So if you don't have a revenue generating company right now, don't focus on getting venture capital. Focus on getting customers, or focus on building development partnerships with somebody who's going to, take equity to help you build your product. Think about getting grants. There's a lot of fantastic grant opportunities out there for-profit companies as well, especially if you're starting a life science company. There are some strategic investors. We work at the Women's Tech Cluster with a organization that is part of Nokia, the Nokia Ventures organization. It's called Nokia Innovent, and they give $100,000 to $500,000 to companies pre-revenue, and that's there's a few different kinds of organizations out there that you can look to if you don't have revenue yet. So try to find those opportunities and focus your energy on the right kind of financing at the right time. One of the big lessons, I think, no matter what, is don't ever assume that you have money in the bank until you have money in the bank, no matter how far you've gone down your discussions. I think Ken has a good story about that. Can I share your story?
Let's look at
Okay.
it. People do change their mind at the last minute.
Yeah, people do change their mind at the last minute. And always have a strategy for growth, I think, without equity capital. I think every time you're going out and you're looking for that next round of funding, think about how you can do it if you don't get that next round of funding, so that you can keep your company alive and build your business, even if you're not necessarily building it in the optimal, highest growth way that you would like to do.
I want to make a comment. Yep. You probably can't underestimate enough friends and family. I'm high on finding strategic investors if you possibly can, but friends and family, never hurt. Everyone here probably knows who Sean Fanning is. He's the founder of Napster. He is doing a new startup, and literally the first $1 million was raised not from any venture capitalists or even anyone who knew what he was really doing. It was all friends and family. This is in the last year. And half of it was probably where the other person was under the influence of alcohol.
Despite the jest, I do want to add a really careful comment to that, because I've seen people raise money from friends and family who couldn't afford to lose it. And if you are going to raise money from friends and family, just be really, really certain. First of all, they should be qualified investors, which means they have a certain amount of assets or income. But be really, really certain that they can afford to lose it before you take money from them, because you just don't want to get in that situation with friends and family.
It's hard enough even when they can afford to lose it.
Yeah.
Well, interestingly, speaking of friends and family, I have sort of a funny one. My godfather used to work for Prudential, and his tennis partner ran, and I won't name the venture firm, but ran a venture firm in New Jersey who didn't invest in Dialogic and had the opportunity to do it at a very early stage. So I know the venture capitalist in New Jersey was overjoyed when my godfather moved to Florida so that he didn't have to see him every week about the mistake that he made.
Well, again, I think it's hard to generalize because I think it just varies so much depending on the kind of business and the size of the opportunity you're going after. But I do think it can be as simple as getting a customer to forward money to you for a development project. I think a lot of product companies start as consulting businesses. And with the understanding that once the product has been developed on a consulting business, the rights to the product will stay with the developer. And maybe a royalty is then paid to that customer on an ongoing basis for the money that they put in early on. I think one of the mistakes that a lot of entrepreneurs make, not a lot, the minority of entrepreneurs actually, given the numbers I was talking about, but is they start with a really big idea. And they think that entrepreneurship is about really big ideas. And I actually think it's about little ideas. And little ideas aren't as expensive. Big ideas cost a lot of money. You have to bring in a lot of money. In order to bring in a lot of money, you've got to tell a really big story about a really big market. And then in order to achieve that, you've got to spend all that money, which means you're probably going to need more money, which means then you've got to tell somebody else about that big market or an even bigger market. And it's kind of a vicious cycle. It can be. It can work tremendously well, but most of the time it doesn't. Whereas, on the other hand, small ideas can be funded for thousands of dollars. I would guess in our portfolio, we've got 55 investments right now. Our average investment in size is about $75 million in terms of the money that we put up today. Actually, over that portfolio, it's probably about $30 million. But I would bet that those 55 companies have raised less money before they became profitable cumulatively than any one of 20 single companies that have raised money in Silicon Valley over the last several years. I would bet cumulatively those 55 companies have raised less than $100 million to get started, and yet they're billions of dollars of cumulative sales. But they started with little ideas. So again, vendors like what Ken talked about, finding somebody with excess manufacturing capacity. There's an infinite number of ways to do it, and it really depends on the specifics of the business.
I was brought in to Aloha by an SBIC fund, and there can be difficulties in getting your funding. So if I were looking, again, I'd think real hard about taking their funding, and maybe it was just unique to the VC that we worked with, but we had real problems in terms of timing of money coming in doing that. I think the grant issue is just a question of what grant you're going for and who you're looking at. There are quite a few SBIC VCs, and I'm sure a lot of them are smoother than the ones that we work with.
For grants, it depends very much on what you're going after, and there's a lot of DoD grants, there's a lot of NIH grants, so it really depends on the industry that you're in.
I would go find successful business people in the domain that you're starting your company in and try and get them to invest. But if they don't invest, maybe ask them to consult and ask them for other people who used to work in their companies who you could go hire. So when you go on a fundraising call, I quickly sum up whether or not that person's going to give me money or not. If they aren't going to give you money, try and get other things out of them, like referrals on good people, referrals on other people who will invest. Because then at least you can go to their friends and say, so-and-so recommended you. At least it gets you in the door. So it would get somebody in your domain to introduce you to other people.
I'd follow up on that, though, to say don't sell yourself short. I think our view is we see a lot of people who've built companies without resumes that would indicate that they would have been able to do that. And they're people who know the markets they're going after. They're passionate about them. They don't have the experience, but they have those things going for them. And we find, and I think you don't have to look very far for examples. If you look in technology, so many of the great companies are still run by the people who started them when they were very young and very inexperienced. So I would encourage you to try to take a business as far as you can on your own abilities. The people in this room are so much better qualified to start businesses than 99% of the people out there. It's really hard to find good, experienced people who are also going to be good business partners for you. Those, if you can find it, it's great, but don't let it stop you.
And I'd be really cautious about finding it. I've seen a lot of people bring on more experienced or, grayer-haired managers to their business and then gone through a whole process of it not working out. And so my advice is to bring people onto an advisory board. If you see somebody or target somebody in your industry that you'd like to work with, you can work with them as an advisor until you get to know them and see, how passionate are they about what you're doing, how good a fit are they with you and with your business. I'm seeing advisors compensated, with some equity. And in terms of structuring those deals with the advisors, you want it, depending on the stage of your business, you want to determine, how long are they going to be advisors to your company for? Is their expertise going to be relevant to you for 1 year or 2 years, and set up some kind of a vesting schedule for their stock based on their term of service, the way you would for an employee. And I don't know what other people are seeing, but we're seeing probably 1/4 to 0.5% of equity, depending on the advisor's experience, what the advisor is going to contribute, and you can do individual deals.
0.5% would be a very active advisor. Mm-hmm. I like to see companies start at 0.1% and then graduate based on performance, because a lot of advisors end up not helping. You don't want to overcompensate them.
That'd be the same for a director, essentially, something in that range?
I think a director, 1/4% to
1/4%, okay.
I don't think venture capitalists look at diversity at all. I mean, look at the number of companies started by Indians in Silicon Valley. I mean, it's huge. And the same for women. I don't think there is any special advice. I think the Valley is very open to creative entrepreneurs.
Certainly from our perspective, it's so hard for us to find companies to invest in that are growing and profitable and doing well. And we were just talking about this yesterday with a woman in our firm, that we have right now very few, if any, companies in our 55 that have women CEOs. Mm-hmm. That has not been, in the past we've obviously had some, but at this moment in time we don't. And someone asked us why we didn't, and the response was given by one of our associates who said, I cold call 500 companies a year, and we have 18 of these associates who are doing this, so calling 8,000 or 9,000 companies a year. And he said maybe 1 out of 100 companies that I call has a woman CEO. It's just really hard to find opportunities. And frankly, I think from our perspective, because we do get asked this question, we get asked it by the pension funds who invest in us and the public funds, we would love to back more women CEOs. And minority CEOs is probably less of an issue because there are so many minority-owned businesses that we do have investments in. But women-owned companies are just hard to find.
So,
it's been our experience.
So, Jeff, I'll send you a list tonight.
If they're growing and making money, send it to me right now.
And to add to that, though, I do think there's more of an issue, not so much of an issue of discrimination, but more of networks and getting into the right networks so that you can find investment opportunities. And I think there are a lot of organizations out there. In addition to ours, there's this Springboard Conference for Women-Led Businesses. There's TIE for Indian entrepreneurs. There's the Forum for Women Entrepreneurs. So there's a lot of opportunities out there to become part of organizations that will help you network with others, of the same minority group or other women who are, trying to get into some of the networks that they need to get into. And so there's some additional opportunities that you have in a way as a woman or minority as well. And if you want to grab my card after, I'm happy to send you an email with some of these other organizations you can learn about and get involved in.
I would just add that in what I've seen, competence is highly valued in whatever form it takes. And the key is just to put yourself in the way of things happening. And so there's probably more of a likelihood that at a party where a lot of Australian wine is being drunk, the two people who are going to run into each other have more of a common background. So the question is, how do you get yourself into the way of things happening? And I think conferences like this are a great way to do it. There are lots of industry events in the Valley that are not specifically around minorities or women, that are just as how business gets done in the Valley. And the more people you get yourself in front of and demonstrate your competence, the better your chances are going to be, and the other factors won't matter.
I think you should look for people with both domain expertise in the product or service that you're designing and marketing, and in the domain of your customer. You actually want both. As far as angel investing, our fund is fully invested and we're not investing any longer. I'm probably a good example of individual angel investors because now I'm investing myself. And in 98 and prior years to that, I probably did an investment a month. I am now doing an investment a year. And most of the angels that I know haven't even done one investment in the last 3 years. So the number of angel investors out there who are actually investing has decreased significantly based on the numbers I just said. They are out there. The Band of Angels is still very active. The Keiretsu Forum. I mean, there are many angel groups out there, and those are probably the groups that you want to talk to rather than individual angels, because the individual angels have really run for the hills and I haven't seen them come out yet. Yeah, even at that early stage, it is similar to a VC deal in that you do just what you said. You find an angel that hopefully is going to put in what will end up being a significant amount of the investment. And that angel, in fact, is the lead. And they end up finding a law firm that they've dealt with, and they end up generating a term sheet based on what they've discussed with the entrepreneur. And then usually the lead angel helps find the other angels. And usually you can incent them to find those other angels more aggressively by saying, hey, I'll give you, another 0.25% of the company in common stock if you raise another $500,000 for my company. That's if you get an enthusiastic lead. If you get an enthusiastic lead, put them to work. You don't just take their money and go look for others. Get them to go look for others and incentivize them to do that. Because somebody else talking on your behalf is much better than you calling yourself blind saying, I want to tell you about my great company. I mean, nobody ever called somebody saying, I've got a mediocre company. If you get the lead angel to make calls on your behalf and set up the meeting for you, the tenor of the meeting is completely different. You go in there with credibility because you're being introduced by a third party.
And is it still done as a preferred stock deal? And are the basic terms the same as you would see in a VC-like deal?
Well, usually the terms are a lot simpler and less complicated than a venture capital deal because a lot less money is being raised. It's usually preferred stock, but because we're in a market that is still somewhat choppy, there's lots of bridge rounds initially. Let's say your lead angel says, I love this company, but I want to invest at $1 million pre, and you are stuck on the fact that you think your company is worth $3 million pre. You don't need to walk away. Say, okay, let's do a bridge financing, and usually with warrant coverage, 25% warrant coverage. Let's do a bridge financing, and we'll let the larger group decide when we can place a valuation on this, and when we place the valuation, then the bridge loan converts into that round of financing. The people who loan the money basically get a discount to the next round because they're getting some warrant coverage. And then, so if you can't get to if you can't get your investor to agree to a valuation, do a bridge to the next round. And they get 8% interest, et cetera, et cetera. I mean, it's a very viable way of doing it. Bridge financings are also very simple. It's a few page agreement.
If I can throw out one other thought on that, at least in the past, there have been issues where angels were sometimes more generous in the valuation than VCs subsequently were. And so the fact that a previous round had a higher valuation becomes an issue in getting your actual first round of venture financing, because you don't want to do a down round early on. The bridge takes that out of the picture and basically puts it in line with whatever the next round is and makes it easier to get on that path.
You know, I've actually, it's kind of a, I don't want to call it twisted angel thing, but a thing I've seen on a board of a company I'm on up in Canada, and actually somewhat similar when I raised money for Aloha, that the company actually put out a term sheet and said, here's the pre-money that we want, and here's the note that you're going to get, and here's the warrant coverage that you're going to get. Will you sign up for it? And after you had a couple people sign up for it, it was very easy to fill out the round and get more people to sign up, some of whom, well, the situation in Canada, actually, about 3/4 of the money raised was from angels and 1/4 from a venture capitalist. So there's quite a few different structures that you can use to do it.
The one caveat I would make on that is if I were going to do the bridge kind of financing, I would try to do it with someone who is an experienced angel investor, because
Yes.
You're starting off with a disagreement. You haven't agreed on the price. You've disagreed on the price, and you've agreed that you'll agree later, which is going to require cooperation on both sides at some point in the future. And it's always better to take money from someone and be in agreement at the time that you're taking it as to what the terms are. If you can't do it, and I think Ron's described a scenario which is reasonable, just make sure you're doing it with someone who's a pro, so that when you get to that opportunity to bring that money in, the person's not going to throw up objections or issues, which is going to make it difficult to raise that money at that $3 million valuation.
Equipment financing is
Yeah.
one that you didn't specifically list, but if you buy a lot of equipment, you can get loans on that equipment collateralized by the equipment itself. And that usually includes some warrant coverage as well. And that's pretty common if you have a lot of capital equipment.
Yeah. One of the more exotic ones that I saw in my first startup that I was involved with, fresh out of my undergraduate years, was a customer of the company co-signing a note secured to fund the inventory of the company. And in exchange for co-signing with the company that note, this particular person actually got better than 50% of the company. But it's another approach that I haven't seen too often. But basically the deal there was that the investor didn't have to put out money to help start the company on the one hand, and it turned out that that customer needed this company to be successful for a year or two because they needed the product. Mm-hmm. The company eventually went under, and the person had to come up with that money and make good on the guarantee, but it was several years later, and they had the benefits of the product being there. So that's another approach.
One other approach, and this is not necessarily something I'd recommend, and it's not necessarily for financing your company, but factoring is just another thing you should have in your pocket, which is basically getting a loan against your receivables. And so if you have sort of short-term cash flow problems you can't solve, that's a good thing to know about.
There's angels who aren't really high net worth who are trying to get return on investment so that they can be bigger angels, make more investments, yada, yada. But then you've got the high net worth angels, which are people, let's say they're worth over 25 million. All the people I know in that class are looking for interesting projects being conducted by entrepreneurs that they like and identify with. Mm-hmm. In other words, making money is not even a factor anymore. I know when I'm on the one deal a year I'm doing now, I am only investing in projects that I think are interesting. Lots of people say, why did you invest in that? For 100 reasons. And my answer always has been, in the last couple of years, it's an interesting project. You know, it's very stimulating to watch how this company solves the challenges that it has. And obviously, you know, angels who are doing this are also involved helping that entrepreneur. So if it's an interesting project, you're going to have an interesting project in the mind of the angel that you're talking to. You're going to get money quicker than, hey, am I going to make money on this deal?
Another motivation is corporate R&D. So Nokia Innovent, I talked about, is somebody that invests in companies early stage to, you know, learn about technologies that might drive the future of Nokia. Panasonic also does this. You know, I did a deal with Deutsche Telekom, and they were interested in financial return, but they were also interested in learning about how our technology could be used in enabling them to get some learnings that would help drive the future of their company. So corporate partners might be another way, whether they have traditional venture capital arms or something more creative like Nokia has with Nokia Innovent, that are not motivated only by money, or sometimes not even by money at all. Social ventures are an interesting challenge because you need to find investors who are interested in both your financial return and your social return, or perhaps, you know, only in your social return, and the financial return might be a bonus for them. So it's, you know, it's really a group of investors that maybe have made it before and they want to do something that has some social impact now that you need to look for. And there are some traditional VC firms that are starting to, you know, set aside some money to invest in businesses for social return. The Keiretsu Forum, which is an angel group Ron mentioned, has money that they've set aside for socially responsible investments or investments in social ventures. So it's really finding the right target investors who are going to be interested in the social impact that you're making, and who are also, I think, professional investors who understand how to do a professional investment deal with you.
Pacific Community Ventures is a venture fund that only invests in your segment, and they're in San Francisco. Well, in an angel round today, I would say you're going to give up 25 to 30% of the company, and then you'll do that again in the venture round, but at a higher valuation.
Okay, well, I want to thank our panelists very much today for coming and for sharing their great expertise and experience with us. I also want to thank all of you for coming, and hope you enjoy the rest of the day.